Ravi, good to see you again. He says the Reverse Iron Condor strategy in the PowerOptions Strategy tabs. No, we don't have it set up. You can set it up on the, you just have to use the custom spread. So Iron Condor, of course, don't have it on my current menus. If we're in a neutral market, another discussion I had during a coaching session this week, but the best time to use Iron Condors, it was related to Iron Condor discussion and quote unquote the wheel strategy, which I hate to use that term because we've been doing that for a while. If you're tracking cash secured naked puts in the PowerOptions portfolio, it'll show you opportunities to roll the put or to take assignment and convert it to a covered call. Investors have been doing it for decades now. Credit to the gentleman who runs the wheel, right? He came up with specific criteria that works for him, just like we came up with specific criteria that works for the weekly picks of the day for covered calls, naked puts, the monthlies, the weekly bull puts, and others. But he has a trading plan that he developed, and that's great. And he just gave it the name, the wheel. But investors have been selling cash secured naked puts and so forth, and converting them to covered calls and continuing to trade that way, just with different criteria, their own trading plan. Now, nothing against him whatsoever. I just don't refer to it that way because we've had it programmed in for over 20 years and been doing it. Ernie's been doing it for over 20 years. But in any case, Iron Condor, great for a melt-up market like we saw in 2021. Hard strategy to be profitable with or to not pull your hair out managing over the last, in certain years, the Powell market of 2022 into 2023. 2024 probably worked out pretty well, but there were some hiccups. There always are. And 2025 would have worked okay in the first couple months, but you probably would have been managing the bear call credit side. And then February through April, you just didn't want to be on the bull put credit side as well. It's a combination of a bull put credit and a bear call credit, both out of the money on the same stock. As long as the stock stays between your strike prices, all four options expire worthless. It's essentially a way to double dip on a vertical credit spread, but you're neutral. You're saying, hey, I've got a 75% probability the stock won't reach this call strike price. I've got a 78% probability the put won't reach this strike price. I've got known risk, not low risk. You've got known risk because these numbers I'm talking about, you're still looking at probably an 8-to-1 or 9-to-1 risk-reward ratio. But that's probably not going to happen 10, 15% of the time, especially if you're not watching the trade and don't management. Now, we don't have a search function, Ravi, for what you're asking for, the Reverse Iron Condor. What's that? Instead of combining a bull put credit spread with a bear call credit spread, you're essentially entering a strangle position, buying a call and buying a put out of the money, and then selling a call, selling a call, yes, and selling a put here. So you have sort of that long strangle. If I just did a long strangle, buying a call and buying a put. But the Reverse Iron Condor, I'm now selling something lower and selling a call higher. So essentially, I'm doing a bear call credit spread on this side that's out of the money. In the money instead of out of the money. And I'm doing a bull put credit spread here that is in the money instead of out of the money. Of course, there's a parity trade that's the reverse of this using debit spreads. So that could be dependent on what you're doing, Ravi. But no, we don't have a strategy tab for that. The best way to do it is in the custom spread tool. And of course, there's two ways to do it. As I mentioned, we could do it as a debit or I can do it as a credit, sticking with SPY. This is something, Reverse Iron Condor, maybe this one a Reverse Iron Condor, I might go longer time frame instead of premium generation with the Iron Condor looking shorter term, 5, 6, 7 days out in time. Let's just go to standard June expiration. And normally in an Iron Condor, of course, let's scroll down to our at the money position so we can see. So here are my in the money puts and here are my in the money calls highlighted in the gray blue area. If I did an Iron Condor, okay, I might be selling the 600 call, buying a 605 out of the money bear call credit spread. Excuse me, at the same time, I might be selling like a 580 put and buying a 575 and out of the money bear a bull put credit spread. As long as the stock stays between 580 and 600, all four options expire worthless. Now, the Reverse Condor I can do two ways. Let's use different numbers. I'm going to buy a 595 call. This is going to be a debit reverse. I'm going to do a bull call debit spread that's out of the money. I'm going to buy a 595 call and sell a 600. So we're paying about 610 for the call, and we're going to get about 395 for the 600. At the same time, I'm going to do an out of the money bear put debit spread. So 595. Let's just go a few strikes down. I'll use 585 and 580. So here we're going to go ahead and buy the 580 at 709 and sell the 580 at 564. 2 debit spreads. All right, so our call debit spread, we're buying the higher and selling, no, strike that, reverse it. We're buying the lower and selling the higher. Here we're buying the higher and selling the lower. And we're just going to use the midpoint prices with one contract for this example. That is your reverse iron condor. This is the debit reverse iron condor. Again, out of the money bull call debit spread, out of the money bear put debit spread, would normally, I'd like to go in the money on those positions. And, it's a good risk reward return. What we're expecting is, hey, I think the stock is going to swing. The underlying is going to swing one direction or the other. I paid a debit of 360, but if I'm right, and in the next 20, 30, 40 days, SPY goes above 600, I'm going to make that maximum profit here. Meaning that I sold a 600 call, bought a 595. I'm going to get 5 points back, and I paid 360 for the entire debit. So we're going to make 140 on an investment of 360, or 38.9%. Or if SPY swings down below 580, reverse. We close the puts 585 to 580. We get the 5 points back on the debit spread, and we make the same amount, 140, 38.9%, and this was 21 days out in time. More time for the stock, the underlying, I should say, to move in either direction. Okay, now you can do this the opposite way. Remember, we talked about parity trades, and out of them, and I would never, ever do it this way, I don't think. But there's 4 ways actually to do it. I can do the same sort of inverse with going the opposite way. I can go in the money bear put debit spreads and in the money bull call debit spreads. That's, I think, the popular approach, Ravi, if I'm not mistaken, is using the in the money strike. So let's go ahead back to that. Let's go there. Let's go to our 21 days out in time. Oh, sorry, folks. Forgive the scrolling. Let's clear all this out. But that's the debit approach. Out of the money bull call, out of the money bear put. June expiration, 21 days away. Let's reverse that. Let's use an in the money. No, that would be an iron condor parity. I'm sorry. The in the money version, geez, sorry folks, let me get down to our at the money strike prices again. The opposite, let's say I did a bull call debit spread. Am I right? 585, 580. Yes. And a bear put. No, an in the money. Yeah, this is where it gets confusing. I'm sorry, I know. An in the money bear call credit spread, I think. And an in the money bull put credit spread. Maybe I'm wrong on this. It's 595, 560. I'm just going to, or 600. I'm just going to try to reverse the strikes. So in this case, on the call side, a normal bear call credit spread is we're going to sell the lower strike and buy the higher strike. And in the money bull put, sell the lower and buy the higher. I think I just created an iron condor parity. No, I did something terrible there. Which one do I have wrong? I have this. I have the bull put wrong. Jeez. There you go. So this one here is a credit of 632 with a maximum risk of 1,000. Why would I never do it this way? The first way is the way I would prefer to do it. Okay. So what I just set up here, the parity trade, it's a parity trade. When you look at it, I mean, the return is, the return is close to the same values here. Instead of paying the debit up front, we saw the debit there, and we were going to get 140 maximum return on a 360 cost. In this case, we're paying we're collecting 632, and the max we can make is 368. So this is actually a little bit higher if you get midpoint. But yeah, that's what I showed you in those cases, okay? So the first example is what I showed you. Ravi said, this is what I was trying to do, bear put debit spread, bull call debit spread. That's what I showed you in the first result. That's what you would look for, okay? This one here is a parity trade to it, but why do I say I would never do this? Because I did an in-the-money bull put credit spread. We sold the 600. Oh, no, it's not in the money yet. It's still out of the money there. No, I apologize. We sold the 600 and bought the 595. Okay, so that's a bull put credit spread that is starting off in the money, right? Stock price is here. It's below it. So our bull put credit spread is in the money near maximum loss. The propensity of in the money puts is to be assigned earlier. So yeah, I get closed out of this and I get the 5 points, but then I've still got that in the money bull call debit spread that's hanging out there. That's why I don't even talk about in the monies as well or anything along those lines. So let's go back. It's please let it work. There we go. Nope. Let me go one more. Please still be there. Okay. Yep. There's our debit spread. That's what you did. This was a bulk in the money bull call debit spread. Selling the 600, buying the out of the money. Okay. You could use the in the money parity, swap the strike prices as well. But Ravi had mentioned this as, oh, I'm using this as a hedge. So what did we talk about here? Thomas asked about a hedge across the broad market of just using the vertical bear put debit spread. Ravi is looking at doing it this way as an inverse iron condor. Say, yeah, I think this SPY, the market might swing this way or it might swing this way. I'm not sure, but I've capped my gains in either situation, which is fine. Again, with what? Again, if the movement matches what you need to get into those green areas, okay? This is the difference with the market hedges. Why we have the different market hedges is because just buying a put on SPY can work as a market hedge. If your expectation is a 7 to 8 to 9% movement, the bear put debit spread can work as a hedge to lower delta, as Thomas mentioned, or, half of what Ravi is looking at in this case, even if he's in the money, bear put debit spread and in the money, bull call debit. But you saw the structure that we set up, Ravi. But again, this works best if you're just expecting maybe a 3, 4, or 5% decline on the position. This one here, you can see your upper break even and lower break even. Your lower break even's at 581.40. And so it's not bad. I mean, we're talking about only 8 points of movement, which is possible to achieve. But if it goes down 12 points, 14 points, 15 points, it exceeds the decline. You've capped the gains, where even though the put was the higher cost, it would have worked better. Straightforward, no management. This is going to be managed. You're going to move these down. You're going to adjust these. I get it. And the same thing to the upside, okay? You're looking at maybe an 10% movement, almost 9%, 9 point, I'm sorry, 9 point movement, 8 point movement to the upside. Okay, so if you have that, you were in a bearish portfolio and you hedged with a bull call debit spread. If you have the 8 or 9 points, that would work okay. If it was 12, 15, or 20 points, buying a call would have been better. Okay, so that's what we're kind of looking at here in those comparisons of the market hedges, Ravi. It's another way to do it. And we could also talk about the higher cost. Why the debit spread instead of just buying a put? Oh, because we lowered the cost and we were expecting only a 3, 4, or 5% decline or stabilization. And so maybe, SPY is here. I do the bear put debit spread. It stays the same, moves up 3%, moves up 2%, or declines 3, 4, or 5%. I've got a decent hedge. Buying the put, it stays the same. I lose money. Moves down 3, 4, or 5%. I'm making a small profit. Goes down 8, 9, or 10%. I'm probably doubling what I'm getting in the debit spread. What is the advantage to what Ravi's talking about here in this structure? The same thing, say, hey, and this is what I do. And Ravi, you've heard me talk about this. In uncertain markets, I did this in 2020. I did it again in 2022 in the Powell markets, and I did it at the beginning of this year with the uncertainty. And it's the out of the money strangle position on SPY. So I enter an out of the money strangle with maybe a 0.3, 0.35 delta, is usually around 0.3 on the call and the put. And as SPY moves up to these prices, and I've got a good percentage gain on the strangle, I don't close it. I just roll it to another 45 to 60 days out with the same 0.3 or 0.4 delta and 0.3 or 0.4 delta here. Then it drops down, re-bracket the strangle, close this one for a profit, pocket it, and re-bracket it now to the lower prices. So this worked well for me in the first 2 months of January to February when we were going consistently up. Worked very well for me at the mid-February through March through April declines. And got a little bit of bump in April, but now my strangle that I currently have open is losing money. But I've already pocketed the capital here. Why do I mention this? To distract from the conversation. This is an approach that I use in uncertain market conditions when I'm not sure about what's going on to happen across the global economy economically, wars, strife, other things of that nature. In a melt-up market like 2021, it was a terrible strategy. Wouldn't have made any money. I would have given up all half, 65%, I think I calculated on my bull put credit spread profits if I used that. No, it's 45% of my bull put credit spread profits if I used that strangle. What is the benefit of what Ravi's doing here? Lower cost. So, sorry about that. I got probably stuck on a crumb of something that I was eating earlier for lunch. But just buying the call and buying the put by itself, I'm going to have a much higher cost basis and an increased much lower break even and a much higher upper break even. Ravi is trimming the cost of the hedge by doing this reverse condor. Just as Thomas earlier was talking about lowering the hedge on his bullish portfolio by using a bear put debit spread on SPY instead of just buying the put outright that has the full cost. He's trying to limit the cost. But remember, whenever you limit the cost and try to look for the better bang for the buck, understand what you're doing and understand the limitations. Yes, bear put debit as a hedge, reverse iron condor as a hedge. Works great, as I mentioned, if the underlying or if the market moves the 3, 4, or 5% down or up that you're expecting. The bear put debit spread is the 3, 4, 5% down, maybe 6% down. If the market moves down more than that, 7, 8% over this 20, 40, or 60-day time frame, or it moves up more than that, you're still going to profit on the position. Not saying that, but just buying a call, doing other strategies, maybe even a ratio call spread with unlimited, a reverse a ratio back spread, with an unlimited upside profit potential might be a better play if you're expecting a large movement. You can always adjust naturally, just like I do with my strangles. If you see more, you get that 8, 9, or 10% movement upwards, well, you could just re-bracket your whole reverse iron condor to the new strikes, just like I do with those strangle positions. Okay. But yes, the strangle does give you higher cost, different break evens. You guys, I know what you're doing. I see it. You're limiting. I'm sorry, you're not limiting. You're lowering your costs into a hedge if there is a market movement. You could do it with a straddle as well. It's going to be expensive, but you're buying the at the money positions and then selling the outer wings here in that bear put debit, bull call debit combination. But again, pros and cons of each. You need the movement to see the profit in that situation. And with the debit spread, with the reverse iron condor, you're going to need to see a bigger movement, I think, in this case. And then that's the other key too. This straddle version, the reverse straddle position would have a higher cost, but would also have a lower upper break even and a higher lower break even, so you could get to profit faster. Just another approach, right? Combination. What are we talking about here? Cost versus reward, and most importantly, in addition to that, risk versus reward, cost versus reward, expectation. Okay. Bear put debit on SPY, SPX, QQQ, NASDAQ, and so forth. Absolutely. They can be a very valuable hedge. If the market stays the same or only moves down that 2, 3, 4, 5% that I mentioned. If my expectation is that the broad market or a particular stock I'm looking at, or a stock that's represents a large portion of my portfolio, is more of a 7 to 8 or 10% potential decrease or increase, then I'm better off, I think, just doing, from what I've seen in testing, what we've seen in other webinars, just doing the long strangle or just buying the put in that scenario, because it's not a capped gain. We have a capped gain with the bear put debit spread. We have a capped gain with the reverse condor or the reverse butterfly, which is what, I saw before. I mentioned doing a strangle with the outside wings. It's a reverse butterfly. Each have their pros and cons. Each have their benefits in the expectations and current market conditions. But if you're expecting a wider drop, it pays to have the extra cost for the extra value of insurance going forward.